Many treat retirement like a static finish line, a specific dollar amount sitting in an account guaranteeing permanent financial security once you cross it. The reality is that your target is always moving. Financial planning operates as a deeply interconnected system. You can spend 30 years building a highly diversified, robust investment portfolio. But if you pair that wealth with the wrong withdrawal strategy, you can still bankrupt yourself in retirement. This funnel chart visualizes your gross income at the top. Before you save a dime, that money is filtered through taxes, essential living costs, and debt obligations. What remains at the bottom is the trickle of capital you actually use to build wealth. That accumulation eventually needs to replace your income. Based on the UK's retirement living standards, a single retiree needs about £11,000 a year for a minimum standard of living, £21,000 for a moderate lifestyle, and £34,000 to be comfortable. But as you can see, those accumulation buckets never fill up if the upper layers of your funnel spring leaks. High interest rates and management fees drain your capital before it even reaches your portfolio. Surviving this process requires running what we can call the optimizer's gauntlet. It consists of 3 mandatory phases. First, debt sequencing. Second, tax-efficient accumulation. And third, dynamic extraction. Because these phases rely entirely on one another, making a mathematical error in your debt strategy or your withdrawal calculations will systematically dismantle the success you achieve in the other 2. Phase 1 requires isolating your non-mortgage debt. High-interest consumer loans and credit card balances act as a severe drag on your capital. Every dollar spent servicing this debt extends the timeline to your retirement. To eliminate this drag mathematically, you use the Avalanche method. This strategy requires you to allocate all excess cash to the balance with the highest annual percentage rate, regardless of total amount owed. This matrix plots the Avalanche method against the popular Snowball method. Snowball provides psychological momentum by clearing accounts quickly, but keeps higher interest debt active. Avalanche minimizes total interest paid to the bank, leaving you with more capital. A severe error people make in this phase is the glacier method. This happens when you prioritize paying off a low-interest mortgage early while carrying high-interest consumer debt. By doing this, you are trapping your cash inside an illiquid asset, while compounding interest actively destroys your net worth on the other side of your ledger. Prioritizing a 3% mortgage over an 18% credit card guarantees you lose money every single month. Until the high-interest debt is cleared, you cannot successfully transition to building your portfolio. Once you reach the accumulation phase, the priority shifts to capturing market growth as efficiently as possible. This philosophy was pioneered by Vanguard founder John Bogle, whose followers, known as Bogleheads, advocate for radical simplicity and low costs. The foundation of this approach is the classic 3-fund portfolio. It consists entirely of 3 broad index funds, one covering the total domestic stock market, one for the international stock market, and an aggregate bond index to provide stability. The trade-off is straightforward. You achieve total global diversification and pay incredibly low fees, but you accept average market returns. You abandon the attempt to pick individual winning stocks. Once you decide on the indexes, you have to choose the structural vehicle, mutual funds or exchange-traded funds, commonly known as ETFs. This matrix breaks down both options. ETFs handle taxes efficiently. When rebalancing, they use an in-kind exchange, swapping assets without triggering capital gains. But mutual funds provide a behavioral advantage, automated fractional shares. Set a fixed amount, putting accumulation on autopilot. Regardless of the wrapper you choose, the math shows that minimizing investment friction, stripping away management fees and tax drag, secures your wealth just as effectively as underlying market returns. The final and most dangerous phase of the gauntlet is extraction. Retirees have governed withdrawals using the 4% rule. The mechanics are simple. Withdraw exactly 4% of your portfolio in your first year of retirement. Every subsequent year, withdraw that exact same dollar amount, adjusted only to keep pace with inflation. This rule has a severe mathematical limit. It was designed and stress-tested for a traditional 30-year retirement. If you were part of the FIRE movement, planning to retire early and live off your portfolio for 50 years, the rule breaks down. This graph illustrates sequence of returns risk. If the market crashes early, withdrawing a fixed amount forces you to sell massive shares at a loss. Over a 50-year timeline, the 4% rule's success rate plummets from 81.9% to just 36%. To solve for an early exit, Vanguard developed an alternative, the dynamic spending strategy. It allows for a higher initial withdrawal rate of 5%, but it requires you to completely abandon fixed, predictable payouts. This dynamic strategy uses a ceiling and floor. In strong markets, increase spending by 5%. In poor markets, cut it by 2.5%. Taking less out during downturns lets the portfolio recover. For a 50-year horizon, the survival rate jumps from 36% up to 90.3%. If your time horizon is measured in half-centuries rather than decades, avoiding a $0 bank account requires you to accept aggressive lifestyle and budget fluctuations. Navigating debt efficiently and building a low-cost portfolio are universal requirements. When it comes to extracting that money, your strategy depends entirely on your specific timeline. This quadrant chart maps out the relationship between the time you have left and the flexibility you can tolerate. The horizontal axis tracks time horizon. The vertical tracks budget rigidity. A traditional retiree in their mid-60s lands right here. With a 30-year horizon and desire for a stable lifestyle, the standard 4% rule operates perfectly. The trade-off for this traditionalist is efficiency. They gain maximum income stability, but because the 4% rule is conservative, they risk passing away with a massive surplus of unspent wealth. Conversely, the early retiree with a 50-year horizon plots up here. Their timeline demands adaptation, making the Vanguard dynamic strategy their optimal path. The trade-off for the optimizer is security. They buy freedom decades early without exhausting their portfolio, but they have to actively maintain a buffer of discretionary expenses, like travel or dining out, that they are willing to cut entirely at a moment's notice when the market drops. Retiring early isn't setting the cruise control and walking away. It requires active navigation, adjusting to the conditions you face to keep moving forward. You have to master the math of the optimizer's gauntlet to build your capital, but when it's time to live on it, select the extraction strategy that actually aligns with your timeline and your tolerance for change.